Dave, before we get your views on the financial markets, provide us with a brief history of Kopernik. When was the firm founded, and what is the investment philosophy of the firm?
Okay, really quickly, believe it or not, I've been in this business more than 40 years now. This is a continuation of what I've always done, investing in public equities with a definite pay attention to value. This was started over 8.5 years ago. Starting from nothing, now we've gone to, I think, 42 employees and roughly 7 billion in assets.
And now that 2021 is over with and we're into 2022, how was your performance in 2021?
Was all over the place. We started out well, hit a bump, did well, and had a tough fourth quarter. But when you add it all up, we were up 20%, a tad above the All Country World Index that most people use. But in the fourth quarter, once again, it was all U.S., which we don't have. But we were happy with the performance, especially on the heels of a real nice 2020. And as we can get to later, things seem to be lining up pretty well for 2022. We'll see.
That's good. I want to get your thoughts on what's going to happen this year. But before we do that, you and your team are really bullish on gold and silver. And as a value investor, I want to hear your thoughts on this and why you are so bullish on the precious metals.
As a value investor, we think that outside of some pockets in EM and Asia, that metals are where most of the value is. Rather than say we're bullish on metals, I would reframe it and say, why is the market so bearish on metals? Yeah, why is it that gold's done nothing for a decade and gold stocks are down a lot? And why is it that uranium and natural gas and things like that are way lower than they were 14 years ago? So we're bottom-up investors, so we can later on talk about the actual values we have on this. But the fundamentals have improved and the stocks have been dropping for a decade and a half. That's where the values are.
2021 was a great year for the broader indices, with the S&P up 25%. Many commodities had impressive moves also. Oil was up 25%, uranium was up 25%, lithium was up over 300%, but gold and silver were down in spite of record inflation and inflation levels we haven't seen in decades. How do you explain this lackluster performance in gold and silver?
Well, one thing we like is volatility. Many people consider that to be risk. We consider that to be opportunity. The fact that people hated gold back in 2002, but loved it in 2011 was a chance to buy in 2002 and sell a lot of it in 2011. Then over the last 4 years, it's mostly been opportunities to buy it really cheaply. But it's been fascinating to us how in any given year they like gold but hate copper, and the next quarter they like copper but hate palladium, or platinum used to sell at almost 10 times the price of palladium, and now palladium trades a lot above platinum. And so we've liked the fact that they've given us the opportunity to, a year and a half ago, be trimming some of our gold stocks and buying copper and buying natural gas and buying uranium, and over the last quarter or two, a chance to trim the natural gas and the uranium and the copper and go back into these gold stocks that are trading in many cases a fraction of where they were 10 years ago.
So on that point, gold is not too far away from its all-time high, but silver is nowhere near it. It would have to go up 100% to get to its all-time high. Why is silver lagging so much, and do you think silver will take out its all-time high of $50?
We don't know the future, but we do believe in fundamentals, and we believe that gold probably goes a lot higher, and that silver is cheap relative to its past, as you point out, and relative to gold. We would not be at all surprised if silver takes out its all-time high of 50. The first time it got to 50 was back in 1980. So, and then again, a decade ago. So, yeah, look what the Dow Jones has done since 1980, what the Nasdaq's done since 1980, and silver's trading at half of that price. I mentioned earlier we actually like volatility. Silver and natural gas being, as you suggest, in many cases, byproducts, causes them to be even more volatile than gold and oil, which creates money making opportunities. So you can have short-term overproduction, but in the long run, price eventually meets its fundamentals.
Dave, what do you say to those investors who are in gold and silver and who are frustrated with this lack of performance? Do you tell them to be patient?
We absolutely tell them to be patient. Always easier said than done. Although I'm really pleased with the client base we have. Having been in the business so many years, you expect clients to run out of patience, but we've got a great client base. They've hung in there. We also are thrilled that uranium's done what it's done, because 8.5 years ago when we started this, we started telling people we really like uranium. And the next year we're saying we still like it. The next year it's down further and we like it. Then it goes nowhere for a while while the uranium stocks keep going down. And we tell people, the way we look at this is you can buy a 10-year bond and get 1% or 2%, or depending on the year it's in, and you've got a lot of clarity. We think the price of uranium is going to triple. We don't know when, but if it happens anytime in the next 10 years, you're going to make nice double-digit returns on uranium. Be patient, be patient, be patient, and they were. And a couple of our stocks from the low point to the high point were up 10x. And if you look back at 2016, some of the options-weighted gold miners we have also had really nice big moves. So with their patience on uranium and natural gas, it makes it easier for us to now tell them, be patient on these gold companies. We think the optionality is worth your wait. It's interesting to us, if you go to a healthcare conference, people will talk about prices are going up forever, and you go to a consumer conference and prices are going up forever. You go to platform companies and they have pricing power, prices going up forever, so on and so forth. Even in the metals, you go to battery metals and people will talk price going up forever. You go to a gold conference and you say, what do you think of gold? And they say, we're bullish. And we say, what are you using in your models? And they say $1,400 gold, some are at 12. I don't think anybody's above 1650 that we know of. And yet the fundamentals for gold in terms of supply and demand, potential demand from all this proliferating currency, supply, nobody's building big mines here. Supply and demand argue for the price to go way higher. And yet the sell side analysts are using lower gold. The companies themselves are using lower gold. Everybody's using lower gold. And they put that in their model. And then they use a DCF on that, meaning any gold that's mined 5 years from now is worthless. We suggest that each passing year gives us a higher chance that the price actually goes up to its fundamental value. And as Lisa mentioned, people can reference our website. We've got a chart. We're happy to send you the chart too, showing the magnitude of difference between a DCF analysis and a Black-Scholes.
So Dave, that begs the question, where do you think the price of gold is going? I know you don't actually have a target price on gold, but you must have some idea in your mind. Does it go to $3,000, $4,000?
When it comes to commodities, we say they're volatile, but they eventually equal this equilibrium price, this price that will incentivize supply to come on. If you have too low a price of corn, people don't grow corn. Eventually, the price needs to come up to get people to plant it. So with gold, it's pretty clear to us it's trading below its equilibrium price. As we mentioned, when's the last time you heard anybody start on a major mine. There's some small ones here and there, but they're not getting built nearly as fast as remaining reserves are falling. So that price we imagine is $300 higher than where it's trading now, plus or minus. The stocks, as Elisa mentioned, are selling, so we think we make money even if gold stays where it is or drops a little bit. But a case can be made, the price goes $300 higher, plus or minus. Now, a lot of people come to us and say, you know, gold doesn't have any use like a commodity. You know, you eat corn and you put gasoline in the fuel tank and burn it. You put copper in the industrial prices, but you don't do any of that with gold. We say, you're right. Gold doesn't sound like a commodity at all. It sounds like money. We don't eat dollar bills, and we don't put euros in the gas tank or put yen in the industrial process. So maybe the right way to value gold is looking at supply and demand of gold versus supply and demand of dollars and yen and euros and those sort of things. And on that sort of analysis, instead of being $300 higher, you can make a case for $3,000 higher. So we're bottom up. We want to buy these things, so we're going to make money if gold stays where it is now. But we look, how much might we make if it goes up 300? How much might we make if it goes up 2,000 or 3,000? And what we believe we have is little chance of downside with chance of massive upside.
Dave, you are a bottoms up value investor, and so is Warren Buffett and Charlie Munger. And as you know, they both dislike gold. And Charlie Munger has some amazing quotes, and one of his best quotes ever, and I'm paraphrasing now, but he said, even if you make money trading gold, you're still an idiot. What do you say to that?
Yeah, we're fans of a lot of the quotes from both of those guys, particularly Charlie. We like to listen to their quotes and agree with 90% of them. We like to look at their actions more than their words, just like we do with everybody else. If you look at their whole career, like us 40 years ago, they liked the fact that real interest rates were huge. Owning gold 40 years ago was arguably stupid. You had some measure of fiscal discipline around the world. You had real interest rates that were 1,000 basis points, and businesses do create value, and gold does not create value. So we have no problem with that. We'll point out a lot of things, though. Warren Buffett said he hated derivatives, but when the price was right, he bought derivatives. He hated junk bonds, and when the price was right, he bought junk bonds. He didn't want to issue debt, but at these interest rates, he has issued debt and continues to issue debt. They did buy silver once upon a time. They right now, and he's very vocal about that people are sitting on cash right now are stupid, that you should reinvest that. So if you take into consideration that for periods of time, the dollar was a reasonable approximation of money, it wasn't as good as gold, but it somewhat held its value. At least you got paid 10% or whatever to hold it. So the right thing to do, and what Warren Buffett has always done, is say, I'm going to hold cash and I'm only going to spend it when I get a bargain in the market. He famously sold everything except for the textile mill in the late 70s, returned the money, say, I'm not going to invest now. Then a couple of years later, he invested when things got cheap. Now people have to go back, in our opinion, of thinking as gold is money. The central banks have made it clear that the dollar is not money anymore. And so I think people should hold gold unless they can find good businesses. They're going to make them a lot of money. right now we have the most expensive market, arguably, in the history of mankind. This seems like a time to sit on gold, despite the fact that it's boring, because as we've already talked, it's underpriced. And it's a way of protecting yourself from the dollar. And like I say, we see Warren Buffett trying very hard to protect himself from the dollar. And then the idea that you should only take gold or any other form of money and draw that balance to buy a business where you think you're going to get a nice return. You invest $1 if you think you get more dollars in the future. You invest an ounce of gold if you think you're going to get more ounces back. That's what we think we are doing when we buy gold miners. People don't even have to like gold to say, well, I can invest an ounce of gold into XYZ gold mining company, and I think I'm going to get back 4 ounces of gold for that. I think that is in line with the way Warren Buffett and Charlie Munger have always thought. You know, he may get around to gold again eventually. We'll see. I mean, he's smarter than we are, and it seems kind of obvious, more obvious by the day, that gold is something worth considering.
I want to thank you for sharing your insights on the financial markets today, and I look forward to our next discussion.
Our pleasure. It's interesting times. Enjoyed the conversation, and thank you.